Assalamu alaikum friends, so welcome to IAS 20 Government Grants. This is a short standard, IAS 20. Okay, so government grants. First, what is the definition of government grants and government assistance? Okay, government grants is like governments are the one who are giving you resources, right? It could be in forms of subsidies or certain tax concessions, it could be anything, right? This is one of the smallest and also easy standard. Okay, they will not give you so complex type of grants and all. Okay, normally they just write the word subsidized loan or government grants like that, or government assistance. These are the normal words that they use. Okay, so government grants are transfers of resources to an entity. Entity are the ones who are receiving resources from government in return for a past or future compliance with certain conditions. Maybe in the past, the entity might have complied with some certain conditions, or maybe in the future they are going to do that, right? So they exclude assistance that cannot be valued in normal trade with governments. Okay, remember, assistance that cannot be valued are not taken as government grants. And also, when you're doing a trade with governments, normal trade with governments, that is also not taken as government grants. Okay, government assistance. Government assistance is government action designed to provide an economic benefit to a specific entity. It does not include indirect help such as infrastructure development. So infrastructure development, it does not include, it is not a government assistance, because infrastructure is for everyone. It is not for only one person. But if it is for just one individual person, government is taking certain actions to help them, it is known as government assistance. Okay. Now let us go to the recognition. Okay. They say that government grants, okay, should not be recognized until the conditions for receipt has been complied with and there's a reasonable assurance that the grant will be received. Two things needs to be met. One is conditions for receipt have to be complied with. Okay, that means you are very sure that you're going to receive that receipt from the government. Number one. Number two, also there should be a reasonable assurance that the grant will be received. Some assurance has to be there that you're going to receive this amount. Then only you can recognize government grants, otherwise you cannot. Both conditions need to be satisfied. Okay, so the grant should be matched with the expenditure towards which they are intended to contribute in the statement of profit or loss. Okay, whatever the expenses related to that grant should also be recognized. It should match with that. Okay, it should be recorded in the statement of profit or loss. Okay, so income grants given to subsidize expenditure should be matched to the related cost. Okay, your income and cost relating to that grant should be matched with each other. Next, income grants given to help achieve a non-financial goal such as job creation should be matched to the cost incurred to meet that goal. Now, grants related to assets. Okay, there are now two things. One is grant relating to assets. What are the types of grant which are related to assets? For example, grants for purchases of non-current assets should be recognized over expected useful life of the related asset. IAS 20 provides two acceptable accounting policies for this too. If it is relating to assets, for example, if you want to buy a non-current asset, it's so expensive that you want government grant for it. In that case, you can recognize this using two accounting policies. And it is also recognized how? Over the expected useful life of the related asset. If it's for 5 years, you need to divide that cost divide by 5. All the 5 years will be recognizing that. Okay. One is either you deduct the grant from the cost. Even from your exams point of view, this part is very important. Deduct the grant from the cost of asset and depreciate the net cost. Whatever the grant you are receiving, you deduct it from the cost of asset and depreciate the net cost only. Here also depreciation is there because this also comes under non-current asset only. The government grants and all. treat the grant as deferred income and realize to profit or loss over the life of the asset. Or the other way you could do is the grant, okay, treat it as a deferred income and release to profit and loss over the life of the asset. So it's an income and it will go in the profit and loss account over the life of the asset. If it's for 5 years, then for 5 years it will be shown as an income. Okay. Repayments. What if you, how to account if you have done the repayment of those grant? You have repaid the government back. Okay. So a government grant that becomes repayable is accounted for as a revision of accounting estimate. Okay, when the grant becomes repayable, then it is accounted as a revision of an accounting estimate. It is known as a revision of accounting estimate. Okay, there are two types of grant. Okay, one is income based grant, one is capital based grant. Okay, what is income based grant? When it's an income based grant, debit the repayment to any liability for deferred income. You have to debit the repayment to any liability for deferred income. Okay, that means your liability will go down, right? Because you are repaying it back, so you debit it. And excess repayment must be charged to profits immediately. Any excess repayment will be charged to profits immediately. Okay, if it's an income based grant. What if it's a capital based grant? Capital based grant, deducted from cost, either you deduct it from cost, either you treat it as a deferred income. So capital based grant, deducted from cost. Increase the cost of an asset with the repayment. Okay, so it increases the cost of the asset with the repayment. This will also increase the amount of depreciation that have been charged in the past. So if your cost of asset increases, obviously your depreciation will increase. Okay, increase depreciation that should have been charged in the past. This should be recognized and charged immediately. Okay, immediately has to be charged. But if capital based grants treated as a deferred income, firstly debit the repayment to any liability for deferred income. Okay, debit liability. Any excess repayment must be charged against profits immediately. Okay, excess repayment will be there in the profit immediately you have to charge. So both these differences you need to understand when it is deducted from cost versus when it is deferred income. Okay, now let us go to the government assistance. That is this all of our government grants, by the way. Don't confuse the two. Government assistance and government grants are two different things. Okay, all these are grants. So make sure you write the word grants, not assistance. For government assistance, what is it? As implied in the definition set out earlier, government assistance helps business through advice, procurement policies, similar methods. It is not possible to place reliable values on this form of assistance. You cannot place a form, any value for this assistance, how much it will value for those assistance. For example, you cannot say that if I help, if the government gives advice to a business, that this will be the cost for that advice. You cannot place a value like that for assistance. Therefore, assistance you just disclose. Okay, you don't recognize it and you don't measure it also. So they are not recognized in the financial statements. So remember, only government grants are recognized, but not the assistance. Okay, so disclosure, clear disclosures. What is it? Accounting policy and presentation methods. What is your accounting policy and what is your presentation methods? Presentation methods, because see, you can present it in different ways. Either, okay, you can deduct it from the cost of the asset, okay, or you treat it as a deferred income. But when you are repaying it, remember, this reverses and this also reverses. What happens when you are repaying it? When you are getting the grant, it is deducted from the cost of asset, but when you are repaying it, it will be added to the cost of asset and depreciation will be more. And same, if it is treated as a deferred income, your liability will reduce. You have to debit liability. and the excess will be shown in the profit and loss. Okay, so the way you show it, it matters. That needs to be disclosed, how you are presenting it. The nature of government grants recognized in the financial statements. What is the nature of the government grant? For example, is it income based or it is capital based? Unfulfilled conditions related to government grants that have been recognized. Sometimes you might have not fulfilled all the conditions to get that grant, but still it is recognized. That also needs to be disclosed. What were the conditions that were unfulfilled? Okay, this is only relating to the government grants. Okay, they didn't say anything about government assistance or not. It is not at all recognized only in the financial statements because you cannot place reliable values in this form of assistance. So remember, in the exam, if you get government assistance, don't go and say that you have to disclose like this. You have to recognize as a capital base, income base. All those are for grants, not assistance. Okay. If you get government assistance, then you just have to write that you cannot place a reliable value. Therefore, they are not recognized in the financial statements. That's it. So now let us do test understanding 2. Okay, what is the question? Discuss the possible accounting treatments about the above. Okay, so this is one and this is one. Let us see what are the accounting treatments for these two things at 31st December 2001. And we are over with government grants. Yeah, that's it. 1st of June 2001, received written confirmation from a local government agency, written confirmation that they would receive 1 million grant towards the purchase price of a new office building. The grant becomes receivable on the day that they transfer the 10 million purchase price to the vendor. Okay. On 1st of October 2001, they paid 10 million in cash for his new office building with its estimated useful life of 50 years. 1st December 2001, building was ready for use. Clock received government grant on 1st of January 2002. So on 31st December 2001 only they want to know what is the possible treatment. So you have been given different dates. 1st of June, you received the confirmation. 1st October, you paid the cash. 1st December, it was ready for use. But you received the government grant on 1st of January 2002. 4 different dates. Interesting. So let us see how you have to do. So the government grant should be recognized when there is a reasonable assurance. Okay. The 2 conditions. Entity will comply with the conditions attached and grant will be received. Okay. The only condition attached to the grant is the purchase of the new building. This is the only condition. Therefore, the grant should be accounted on 1st October 2001. What happened on 1st of October? That was the date when they have paid the 10 million in cash for his new office building, because that was the condition for the grant. They told this 1 million grant was for the purchase price of a new office building, right? So this is a condition. So when they purchase the office building, that day onwards, this grant will be recognized. So it will be recognized on 1st of October 2001 because that was the date when 10 million was paid for the new office building. Okay. And also the grant becomes receivable. The clock transfers the 10 million to the vendor. So on 1st of October 2001. The receivable will be recognized for 1 million due from the local government. Clock would then choose to either so. Now he has an option. You told you receive, okay, 1 million. Now how are you going to recognize it? You have a choice, okay. Number 1, either you reduce this from the building by 1 million, the cost of building, which is 10 million is the cost of the building. You reduce 1 million, then it becomes 9 million. Then you depreciate. Or otherwise you recognize 1 million as a deferred income. But first we'll go by A. What happens? Building will have a cost of 9 million then. 10 minus 1. It will be depreciated over 50 years. Depreciation will be charged in profit and loss. How much? 9 divided by 50 into 1 over 12. Why 1 over 12? Why is it 1 over 12? Think. And so you deduct this depreciation from the carrying 9 million, and this becomes the carrying amount at 31st December 2001. Okay. The building was ready for use from 1st of September 2001. So from 1st of December 2001, and you have to record on 31st December. Only for 1 month you can record depreciation. You're understanding? For the current year. Because according to IAS 16, depreciation you can only calculate when it's ready for use. Okay? So that's why you're taking 1 month only, 1 over 12, 1 month. That December month only you will recognize depreciation. If it is recognized as deferred income, okay, the cost will be 10 million. It will be depreciated over 50 years. So 10 divided by 50 same only for 1 month. This will be the depreciation. So carrying amount will be 10 million, not 9 million, minus that depreciation at 31st December 2001. Deferred income will be amortized to profit and loss over the building's useful life. Remember, when it's a deferred income, it will be amortized. It should be amortized to profit and loss over the building's useful life. So what is the building's useful life? What is the amount of the grant? It's 1 million. 1 divided by 50 because for 50 years and only for 1 month it will be amortized. This will be recorded in profit and loss. Okay, at this date. Don't worry about OCI and all. Nothing goes to other comprehensive income relating to government grant. Everything is in profit and loss. So now the carrying amount of the deferred income balance within liabilities on the statement of financial position will be how much? 1 million minus this. But this income that you have recognized, you deduct it from 1 million, the grant. That becomes the closing balance for your liability in the statement of financial position. Okay, so that's it. So the next standard is also another short standard, which is IAS 23.